Ladies and gentlemen, welcome to the Ultimate 2026 IBC Carrier Comparison Guide. If you've been following our IBC with series, this is the ultimate summary of all 10 videos that we've done with some of the top mutual whole life insurance carriers with the really one goal in mind, answering the question, what is the best insurance company to work with when it comes to infinite banking? And maybe like your favorite politician or whatnot, we're not going to give you the direct answer, but in each series, we went through some of the top things that really matter as it relates to death benefit, early cash value, long-term cash value growth, loans, how they work, direct recognition versus non-direct recognition, the PUA flexibilities, how easy are they to work with as an advisor, as an agent, and just even like the little things like the portal, how getting access to a loan works. And so that series, if you have watched and commented, and it's been an incredible series, there's a lot that we've learned, and I'm just very grateful for it. I guess I get to take a slight credit for it because I get to be the co-pilot with you, Alden, but you have done a tremendous job getting the data from companies that we've worked with, maybe that we haven't worked with, and really trying to lay them out. We've even gone the extra mile and looked at cash flow design policies, which is our way of saying you fund the same premium each year, and looking at the initial cash value, break evens, the capitalization period, how the death benefit increases. So we've looked at that from cash flow designs and front load designs. And we're even in this video going to summarize all those numbers, looking at the death benefit, the cash value buildup, as well as comparing all the things that we've did in our 10 videos together all in one place. And it feels like a lot. Buckle up, get your notepad out, because it is. We're not apologizing because this is what we set out to do. And I just also want to just give a quick disclaimer. We're doing our best with the data that we are given. We always want to get better. And throughout the series, we've heard from many insurance companies because a lot of people are watching. And I'm already excited for future series. And we are committed to being better and continuing to be as open and honest with what we're learning. So, Alden, before we jump in, I'm curious, what was the biggest takeaway that you got from this series? I mean, we looked at so many metrics. Was there one thing that jumped out to you that was like, this is interesting, or like, I didn't think about this, or like, because we're always learning. I know that you've learned a lot by putting this series together. Before we jump in, anything that you want to say?
Yeah, well, super excited to be here and wrap up this series. I've had a lot of fun doing it, learned a lot along the way. I think the biggest thing that jumped out to me is honestly how a simple concept of paid up additions is so different at every insurance carrier. How the rider it works with the policy, how it's underwritten, the limitations that are built into it by default. And so I mentioned in a side conversation earlier, Caleb, when you and I were talking about this, but we've been doing whole life insurance for a long time, and it felt very good to look back at the policies we've sold in the years previous, knowing that we almost accidentally ended up working with the companies that oftentimes were the most flexible. And so going through this process, looking at new carriers we haven't worked with as long, and identifying the benefits and the ratings and everything else, we've set our clients up very well. So that made me feel really good, while also expanding my knowledge of, hey, maybe we should start looking at this carrier over here for certain clients. So it's been a fun process.
Well, two things that have jumped out to me is a lot of times people ask, like, what is the best insurance company to work with? And it's impossible to answer, mainly because it depends on what you value. Where do you live? What's your health rating? There's a lot of factors, and I think people will realize like how hard of a question that is to answer, and they might appreciate the work that we do and other people do that really try to do the best for their clients. And so that's just one takeaway, is you got to look at different factors. I really liked in our series when we did the pros and the considerations, because it helps highlight that every single company that we highlight has pros and they have considerations, and you have to factor that in. And then the other thing that you mentioned was the paid up addition flexibility. I've always said like whole life sometimes is put in a corner where it's like, that's not flexible at all. And there have been in the past, depending on how you design it, where it might not be flexible. But with the idea of paid up addition riders, almost all these companies have the flexibility to not pay, but some companies really, really highlight the flexibility of what happens if you don't pay your paid up addition this year. Can you go back? Can you have the flexibility to pay some? It's something that has been a value of mine, but I wasn't able to fully articulate it as it relates to all 10 companies. And this series has really opened my eyes to like maybe why we were attracted to companies that we end up writing with more than others because of that flexibility. Because flexibility does not show up in cash value IRR. And people follow my work, they know that cash value IRR for me is something that's way more important than maybe looking at the dividend because it's the actual growth, cash on cash. The problem is IRR only shows one or maybe two benefits, and life insurance is multi-beneficial, and life happens, and giving our clients flexibility matters. It's hard to measure in a number, but it matters. And I feel like an old person by saying this, but being in this space for as long as I have, I've realized that sometimes really perfect scenarios, including mine, might look good on paper, but we don't know what 5 years from now is going to look like. And so that flexibility can really be the make or break, especially if you're going to max fund or overfund whole life insurance for the ability to use the living benefits. And so with that, Alden, before we get started, anything you want to add as we go through? And I think what we'll do, because we're going to go through a guide that people have access to. If you have not seen this guide yet, you can get this guide and follow along in the link down below. And it's something that we're committed to continuing to update. And there's a lot here. So Alden, you're going to kind of take the lead. I'll color commentate, but we're not going to make this video 5 hours. So we're going to move this along. There might be some pages that we don't cover. You can see that down below. And then we're also going to look at a very intimidating Google sheet of all the cash value numbers, death benefits. I'm excited for that because I love seeing the numbers, and we're going to kind of highlight the winners in different categories.
Absolutely. Well, what I'll add just briefly is if you've been following our channel, you've been watching the series as it comes out, we've already sent out a guide. That guide at the time had 8 carriers. Then we sent out one with 9 carriers. This is the culmination. This is all 10 carriers and everything's in it. So excited to jump in and really dive into the details here. So today we're going to be looking at 10 insurance carriers. So going from one side of the arena all the way to the other. Some mutual insurance companies, some mutual holding companies, and even a fraternal benefit society. So new word for a lot of us in the room. We're looking at Ameritas, Foresters Financial, Guardian Life, Lafayette Life, MassMutual, New York Life, OneAmerica, Pan American, Penn Mutual, and Security Mutual life insurance products. So it's going to be a whirlwind, but let's dive in. Now, we've jokingly said it throughout this series that the product and its design is really what matter most. If you're working with a top mutual carrier, you're likely in a good spot. But how can we make that a little bit more efficient? By choosing the right carrier for your specific situation. At Better Wealth, we believe in the better way, which is effectively removing friction between you and what you're after. And so for today, we're going to be looking at some specific details. And depending upon what you value, that may highlight for you which carrier may make the most sense to work with. So early cash value, PUA flexibility, and long-term performance are the 3 big ones, although we are going to add in some other layers to this as well.
And Alden, I'm just going to jump in to give a little bit of perspective. So I recently had Tom Gober on our channel, and he has tons of research on every insurance company out there in the United States. And there's over 700 insurance companies out there, okay? Just for perspective. We're going through 10 right now. So we're obviously being critical. We're pulling back a lot of different layers. But I want you to know if any one of these 10, that's less than 2%. So we're talking literally on the 1% of carriers for quote unquote infinite banking. So just want to give that perspective because again, with that, sometimes we can lose perspective and some carrier might be like 8 or 9 or be like, oh, they're awful. Awful compared to what? If we did all 700, which maybe AI could help us in the future, we would know that like all of these would be so far ahead of majority of the carriers out there. So again, it's important for perspective. And I think that is maybe this disclaimer that I want to give because if you're with one of these 10 carriers, you're already doing so much better than what you could if you just like randomly picked an insurance company and tried to do infinite banking style policy with that.
Absolutely. Absolutely. Well, these 10 carriers, like Caleb said, they're a reason we're looking at them. And all of them have been paying dividends for an extended period of time. The average across the 10 carriers is around 132 years. That's a lot of value and benefits shared back to policyholders. Now, another metric that in personal opinion is just overhyped in the insurance industry is the dividend interest rate. So that crediting rate into the insurance policy. Average right now is 6.05%. That's amazing. What does that actually translate into the product? And that's what Caleb touched on earlier from an IRR, internal rate of return perspective. So we're going to dive in and you can kind of see what we mean when we're talking about that. Now, to briefly filter, let's say, the audience that may be watching this. If you live in the state of New York, I love you. I've got family up there. doing business with you is a little bit more difficult because not all carriers want to do business in the state of New York because of some of their insurance laws. So we have 5 carriers for you: Ameritas, Guardian, MassMutual, New York Life, and Security Mutual. For everybody else, you have those 5 plus Lafayette, OneAmerica, Penn Mutual, Pan American, and Foresters. All right, so each one of the carriers, when we looked at them, we wanted to assess their financial strength. The easiest way to do that is to look at some rating agencies. There's a couple of big ones out there. There's Fitch, there's Weiss, there's AM Best. AM Best is almost always the most known, so we picked that metric. And then on the other side, we also have a Comdex rating. Comdex, think of it as a conglomerate score. It pulls from all the major rating agencies, puts it into a score out of 100. This is a percentile score, not a B or an A plus, right? Percentile meaning if you're 100 out of 100, you're in the top 1% of insurance companies in the United States. If you're, like this example here, 83, you're in the top 17 percentile in the United States. So when we're looking at this, you'll notice that the vast majority of these carriers are over that 90% mark. And that's really what we try to hit. We're trying to hit into the top 10 percentile of these insurance carriers because we're wanting to set people up with a banking system. We want something that's going to be reliable and there for a very long time. Now, not to say or besmirch the reputation of some of the other carriers on this list, but this is something to understand, that you're going into business and partnering your protection with an insurance carrier for an extended period of time. Many of you may have insurance policies, maybe not with mutual insurance companies, that you're also buying your property and casualty, your auto insurance from. Look up their Comdex score. You may be surprised about what their ratings are. So a couple of quick highlights as you kind of peruse the screen here and see what we have. Foresters, because of their fraternal benefit structure, they don't have a Comdex rating. So it's not that they're too small, they're just different. So for them specifically, refer to that AM Best ranking. Guardian, New York Life, they're actually the powerhouses in the room, as you may have noticed. A++ ratings in AM Best. And another rating that I checked is the Weiss score. This is like the safety score. It's a B+. They're only 2 of very, very few insurance companies who've ever attained this score. Getting an A on a Weiss score is basically impossible as far as I can tell. I had carriers with a current A. Penn Mutual. This is a unique carrier on the list for one big reason. They are the only carrier in the insurance industry to have maintained an AM Best rating of A or better for 98 years. And after talking with some of the executives at Penn Mutual, they're obviously shooting for 100. So I think that's a really big talking point for Penn to be able to claim that, and none of the other carriers that we're looking at can. Some are really close, but Penn has that lead for sure. All right, Caleb, when you look at this slide, what gets you excited?
This is probably my favorite page in the entire guide because it really highlights not only the Comdex score, which I think is an important metric, but it also gives you the high and low IRR, which is, I think, it's a better, more accurate representation than the dividend rate. But then also, because PUA flexibility is something that more people should be talking about, I actually think we're going to start seeing people talk more about PUA flexibility because we've noticed that as we talk about things, people change their language. And this is something that we feel so strongly about that we added to this, comparison page. And, while 5 stars aren't perfect, we very much highlight in our entire 10 video series the companies that really are great when it comes to flexibility, meaning they have more stars. And then if you have a 1 out of 5 stars, that doesn't mean you're bad. It just means you're less flexible when it comes to the PUA. So between IRR and PUA flexibility, these are 2 that I just love, that it just gives a snapshot of what's going on here.
Absolutely. And it comes back down to what we said before. What do you care about? What are you going after? And how do we back into the right carrier and product for your situation? Because every carrier is different. So this is just the highlight screen. Let's go into some more details here. So when we're looking at best carriers for a different profile, right? It's a different purpose behind getting an insurance policy. I've categorized these into 7 different types of people, if you will, personas. So the first is going to be, who's that long-term wealth builder? Well, they may want to go with a company like Penn Mutual, industry-leading internal rate of return over a long period of time. If you're wanting to maximize early cash value, we've got really 4 other options for you. They have the highest % return in that very first year from a leverageability perspective. the conservative investor or the institutional investor, if you're playing in that sphere. Guardian and New York Life, they are 100 out of 100 on the Comdex score, and they're one of the big four mutuals. So a lot of safety and security by working with those brands. If you want flexibility, like we alluded to before, not all carriers are created equal. Penn, Foresters, OneAmerica, maybe those are some options to look into if you really need that flexibility year to year, and you may want a catch-up provision. If you miss premiums, you want to be able to fill up last year's unfilled premium bucket. Now, this is always a funny, Phoebe, the IBC purist. Which carrier really wants you? I feel like Uncle Sam pointing at the screen, right? Those old recruiting posters. IBC purists, these are companies that openly say, hey, if you want to do infinite banking, we got you. What we found over the 10 carriers that we worked with is the majority, they don't say that. They may build products to allow for that. One of them openly says we don't want IBC, but these two specifically said, hey, bring me your huddled masses or whatever the Statute of Liberty says. So they want that business. So I found that to be very, very interesting. If you're looking for a balance, perhaps Penn Mutual, Lafayette Life, and then the last one I've put on here, which is just very interesting, Fraternal Benefit Society with Foresters Financial. They've got a social impact saver persona is what I'd call it. There's some unique benefits there. We'll go into some more detail, but think of it as you're not just buying an insurance policy, you're joining a membership that also has some other perks.
Mm-hmm. A couple things I'll just mention here. Obviously, we're using the word investor and wealth builder. And just to be very clear, you're not investing in insurance, but we're just using personas because some people resonate with different things. And then the other thing is like the IBC purist, like this matters, especially if you're an agent or an advisor that really, really, really buys into the IBC message and fractional reserve, all those things that you may resonate with a carrier that really helps you embrace that from a messaging point. And so that does matter, and maybe that matters to the consumer standpoint. So I'm really happy that you highlighted the different types of people, because this is, again, where it's hard for us to say this company's best across the board. And quite frankly, we could create more boxes. We could have the unhealthy smoker approach. We could have the overweight person. We could have the 60 years old and we could have the you want to mech a policy and CD alternative approach. Like there's lots of other approaches, and you might find that one thing that we're not highlighting heavily in this is underwriting. Underwriting matters. That's why it's important to work with multiple different carriers, because one carrier might look really, really good if you're super healthy, but another carrier might look better or give you a better rating depending on the inputs that you're giving. And so that's something that maybe for a future video, we just focus on the health side, but it's one thing that's not necessarily showing up in this, but there are other factors that matter. And we're also, you have to realize, like, if you're in the state of New York, these things can shift as well. So just wanted to give that disclaimer as well, that not to undermine the work that went in, but we, doing this series, had to pick, hey, what are the core things that we're going to talk initially? Because we could make this too much information. And some of you might be commenting and saying, this is already too much information. I just wanted to give that context as well.
If you've got the guidebook, it's already 75 pages. Like, what do you want here? So it's a very, very good point, Caleb. And I'm going to throw some names in the hat. My case manager, Victoria Rickel, and longtime OG of Better Wealth, Alice Landsberg, would love to have you guys on the channel and talk about some of that health stuff, right? Which carriers could we go to if you use nicotine patches and not get a tobacco rating? There's a lot of really good stuff that our team has figured out over the long time we've been doing this. So I'd love to see them on the channel talking about it. Now, this is that metric I mentioned before. This is the overhyped, in my opinion, dividend crediting rate, dividend interest rate that is announced by these insurance carriers. In a nutshell, though, what is it actually doing? And the problem is sometimes, and unfortunately I've seen agents tout this nonsense on YouTube, is that we say, hey, look, MassMutual is paying a 6.6 dividend rate. That means your policy is compounding at 6.6% tax-free. No, that's not correct. That's not how that works. So Caleb, I'd love for you, if you want to break that down for us. And as we comment here, you can see we've got, out of all the carriers, we're all in basically the same category, within about 1% of each other, driving forward with that mutuality benefit, paying back to these insurance policyholders.
I'm curious. I'll share my thoughts on dividends. Is there's some carriers that don't disclose their dividends. So I'm curious how you got those numbers. But the dividend is just stated this is what we're quote unquote crediting to the policies, and then they subtract all the expenses. That's like the easiest way. All the expenses, all the mortality, and then you get the actual crediting rate. And so that's where we look at IRR, because is IRR accurate? No, but it's way more accurate than dividends, because it shows you based on their dividend, how does that actually impact initial and long-term cash value, and comparing there. So I think this slide, while I think it's important that we mention, is literally one of the least important slides and pages, just because it's like it literally does not matter, because you'll find, just highlight Penn Mutual. Penn Mutual is not necessarily the highest dividend, but they're doing other things. They're lean in other areas, and you'll find that it shows up in how they do their projections. And so it's just one of those where dividends matter is looking at long-term history. It's like, okay, how is someone's dividend? What's the history of their dividend? That is something, again, could be a future video where we look back 10, 20, 30, 40 years. Some of these companies are really hard to get that data, but I look at it more as a, how do we do trends, and like, how are people, is their stating dividends staying similar? Is it going up and down? That would be more valuable to me than like, oh, MassMutual has the biggest dividend, meaning Mass is the best. And I don't think that could be further from the truth. And it's not even true as it relates to the cash value growth, because you would think, looking at this, that MassMutual has the best long-term performance, bar none. And that's not always true.
That's right. And to answer your question, OneAmerica, Security Mutual, Foresters, and Pan American technically do not disclose their dividend interest rate. So how the heck did I get the number? Well, I'm guessing, but I'm guessing based on the Society of Actuaries. So they have a whole lot of data that tracks mortality costs and the policy growth over time and all these different things. And so by me, I said, I went and got the data and I said, hey, Gemini, figure this out for me. And that was really helpful. So when we look at this and we can see some of these carriers used to declare dividend rates and they stopped and they've said, hey, we're more profitable than we were then. Just collating data to say they're all around 6%.
Hey, I'm interrupting this video briefly to say, if you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company Comdex scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment. Now let's get back to the video.
All right, so the page that I think makes a little bit more sense outside of dividend interest rate is what's actually happening in the policy, the internal rate of return. And so it's less broad than a dividend. It's hyper-specific to your policy. What do I mean by that? A dividend is, hey, everybody gets this number. How it affects your unique situation, how your policy is structured, your specific underwritten mortality costs baked into your premium, all that affects it. So what we're looking at today is just the small, narrow corridor of what I looked at. So an individual in their 40s adjusting different health ratings, adjusting the premiums, and we're looking at this internal rate of return for each of these companies. So along the bottom, we have the abbreviation for each of the insurance companies we have here. Along the right-hand side, we have 0 to 5%. That would be the internal rate of return. And as you can see on the low side, it's going to be that bottom line. High side is that top line. So if we just go left to right, you can see that there's usually around up to 1.5% difference between the highs and lows for the products and the carriers that I reviewed. Now, the things you'll notice is that, again, we're all pretty similar. We're floating around this 4% on average with some outliers above and below. So the big outliers we'll point out to here is, of course, Penn Mutual. Penn has a phenomenal track record with internal rate of return. Perhaps, Caleb, we were talking about this earlier. We can do a video on some of the policies that were sold 25 years ago that have performed within 1% of where they were projected to be. So that's obviously a very, very strong claim to fame. MassMutual, highest dividend, IRR is not quite as high as some of the others here. So it's just interesting to note. And then some of the smaller carriers do come in with lower internal rate of return. This is partially due to the build of the product, but also due to the dividend being credited into that policy, which does affect the internal rate of return.
Yep. Yeah, I think you articulated that extremely well. And again, you're going to notice as we go through, there's some companies, especially when we look at the cash breakdowns and the death benefit breakdowns, there's some companies that shine very, very well outside the gate. I'll take Forrester's, for example. I think I was pretty amazed when I looked at their initial cash value, and it's impressive, but there's a potential opportunity cost the longer you zoom out. So if someone only cares about 10 years or less, okay, great. And you could say like, hey, I don't believe anything that these insurance companies do. Like, I don't care about 30 years from now. I think that's a interesting talking point, especially since we're talking about whole life carriers. We're not necessarily talking about these being like crazy different, but I think that if that is a value of yours, you care more about initial cash value. And if you're like, hey, I like the idea, I'm doing this for 40, 50, 60 years, a 1% to 2% different in IRR could be a huge difference to not only your death benefit, but your cash value. And so I think that this graph is interesting, but I also think overall very similar, even though we're talking about a potential 2% swing.
Absolutely. And we'll dive into some more specific nuanced numbers from the illustrations we reviewed during our series, so you can put dollar figures to these percentages that we're looking at as well. Now, Caleb, I would wager that you and I have the same favorite slide for the first time ever. I think you were lying about that slide we went through before, but I would say this is our favorite slide on the PUA Flexibility Ranking. Am I wrong?
You're wrong, because I like the summary of looking at IRR and the stars. The stars, I don't know. The stars are enough for me. I'm like, okay, but I think that this fleshes out the star ratings a lot more. So, but close. This is in the top 5.
No, sure. top 5. Oh, top 5. All right. Well, I love details. Caleb's a little bit more big picture, I suppose. So when we're looking at this, guys, we've rated PUA Flexibility Rankings. So this isn't the carrier itself. It's their PUA rider and how it interacts with the policy. So if you have our guide, you can read through all of these in detail. But what you'll see is that there are really 3 or 4 carriers that stand out with very flexible PUAs. This would include perhaps a backfill ability. If you miss a premium last year, can this year you pay last year's premium, right? Can you catch up in that way? Other things are, hey, how many years can I skip if the sales job I have isn't performing for a couple years, but then I have a great year? Can I come back up and put in my maximum premium? Some carriers, yes. Other carriers, a big fat no. So it's really important to understand with your funding desires, your funding style, who you're going to work with, and making sure you understand the limitations within that insurance product and the flexibility. One of the classic example I'll just give here is MassMutual, phenomenal company, very strong financials, and they've got like 7 or 8 different whole life products that all perform the way they're supposed to. From a flexibility standpoint, they're not doing so hot. If you miss a premium payment more than 2 years, the rider goes away. If you want to make more than 3 payments in a policy year, you don't have that option. One of the riders you can't pay any other time but the policy anniversary. So if you're very financially stringent and this is a part of a future retirement plan, you know you can hit your premiums, by all means, MassMutual is a phenomenal carrier, and that's where we start to use that carrier. But if you want a little bit more flexibility, like with Guardian, maybe there's no backfill, which we'll touch on that in a minute. Maybe there's no backfill, but hey, I can do 10 times the base premium at any point while I have their Q term rider on there. That's a pretty nice flexibility, but what happens when the Q term's gone? Now you're limited 1-3 or a 1-to-1 ratio. And then another example, OneAmerica, really like the way their product works, and they have no other minimum than $120 a year. You have to pay into that rider. And at any time, at any point during the policy, you can pay 3 times the base premium in PUA. That's pretty flexible. But when we start looking at all of the data, all of the little pieces that make each rider unique, we see this ranking come through. With Penn Mutual, they have a very strong flexibility year to year. They have what I call anytime payments, as a lot of these carriers do. They have a full catch-up provision, and you only have to do 50% of your 1-year max premium in a 5-year period. We broke that down in another video, but I don't think I need to go into more detail here, Caleb, unless you want to.
No, I think the only thing I would just mention is MassMutual is a phenomenal carrier, and they've said publicly, like, hey, we don't want infinite banking business. And not that they don't allow high cash value buildup, but they've just been pretty clear about that. And they are backing it up. It would be pretty hypocritical of them to say, we don't want you to do this, and then they give the most flexible product out there that allows people to do this. So they're backing up what they're stating publicly. And so it's one of those, when I look at these, I don't get upset. Insurance companies get to decide what type of business that they want. And you can see that both New York Life and MassMutual, they're one of the biggest. They don't necessarily, quote unquote, need this business. And they don't create products that make it tempting to be crazy flexible about. So yeah, that's all I'll say about that. But we can move on. Love this slide though.
Okay, the elephant in the room that's been here since the beginning that nobody really wants to talk about. Direct versus non-direct recognition. So this slide, we're just identifying which carrier practices which. You can see on the right, Lafayette, Mass, New York Life, OneAmerica, Security, Foresters, and Ameritas all have non-direct recognition options. Small caveat, MassMutual does have some legacy products where you can do direct recognition loans. Direct recognition on the left-hand side, the big two are Guardian and Penn Mutual, and then also Pan American is a direct recognition, and then Ameritas again. One of the cool things that I do really like about Ameritas is it's kind of like pick your adventure. Every time you take a policy loan, if it's a brand new loan, like you don't have an outstanding balance, you can choose a fixed rate that is issued with your contract and will never change, or the variable rate, which changes annually. Fixed rate is direct recognition, variable is non-direct. We have to remember, insurance companies aren't going to lose by lending you money. So whether they're directly recognizing or they're charging you a full variable interest rate, the effect to them is effectively the same. The effect to you as a policy owner can be very different. So on this next slide, we'll kind of break down the differences and why one may work better than the other. All right, so outside of it just being a talking point, what does direct recognition actually mean? What does non-direct recognition actually mean? What I've done on this slide is kind of give you an idea of when one may make more sense than the other. Now, our opinion at Better Wealth is because, remember that phrase I said before, insurance companies don't lose. That's why they've been around and been profitable, some of these carriers, for almost 180 years. And because of that, it kind of comes out in the wash with the way that their policies operate over a long period of time. Year to year, you may think, oh, that would have been better, or this would have been better. Look over a long period of time, like insurance companies do, they don't lose, it comes out in the wash. So when we're looking at how it may affect the policy, direct recognition just means that the dividend that's being paid on the loaned value that is collateralized is going to be different. Different means up or down. Depending upon interest rates, you may have a higher dividend or a lower dividend. Now, in general, it is lower, but there are circumstances where it's higher. So two of the carriers I want to highlight here, Guardian is actually really unique. A lot of the real estate investors we work with like Guardian because they have a fixed cost of borrowing. They know exactly what their interest rate is going to be. 5% for the first 10 years. It's predictability. After 10 years, they can choose. They like the fixed rate or they want to go a variable rate. So you have that long-term option as well. Penn Mutual, they guarantee a spread off of the dividend interest rate to the loan rate. That spread early on is 0.65%, and then after 10 years, they flatten that line out to 0%. So for rising interest rate environments, when interest rates are going up very rapidly, direct recognition is the best place to be technically, because we have this situation where the interest rate that you might be borrowing from is increasing much faster than your dividend rate. So there's that potential for, because these are connected on direct recognition, for that dividend to be pulled up more quickly on loaned values. So where we often see direct recognition shine is the long-term value of the product. And if we know exactly what our future cost of borrowing will be, or we have a set spread, distributing income out of the policy in the future becomes a much easier mathematical scenario to model and to do on a year-to-year basis. Our shout out to Hutch over at Banking Truths did a phenomenal video breaking down these two topics and showed why direct recognition in a distribution phase can be so valuable. Now, non-direct recognition. It has been long said and touted in the infinite banking community that the only carriers to work with are the ones that are non-direct recognition. I disagree. I think the product, how it functions, is far more important than the loan recognition in the vast majority of cases. But I will say non-direct recognition is very easy to understand. You have a growth rate, you have a loan interest rate, and they don't play catch. They're completely separate. So it's predictable that the dividend does not change when you do any borrowing. Falling interest rate environments, this is actually a very good place to be. We've heard perhaps on YouTube and some practitioners out there saying and claiming that there's always arbitrage when you borrow against whole life insurance. I'll challenge that here officially, and we can break down the math later. But if we think about this, if interest rates, I'm going to go to the late 80s, were 15, 16%, I think highs of 17%. Dividend rates were also fairly high, 10, 12, 13%. But where are the dividend coming from? It's coming from their massive portfolio of many different assets, bonds at very high percentages, right? And so in that scenario, when interest rates fall that next year, let's say they went from 17 to 15 to 14 to, et cetera, those bonds don't mature right away. They're still earning that higher interest rate environment return, which means now we have interest rate in dividend, and they're doing this. So the dividend usually sustains 2 to 3 years before it starts decreasing in a lowering interest rate environment. So why am I going into this detail? You can imagine if interest rates fall very rapidly, but dividends remain high for another couple of years, and they're falling over a decade, all of a sudden, you're borrowing against an insurance policy, making up numbers, at 5%, and the internal rate of return of your policy may be higher. Your dividend may be higher. That's where the arbitrage claim has come from, because in certain periods of history over the last 25, 30 years, we've had that situation happen where I'm borrowing and, hey, my policy is making more money than what I'm having to pay the insurance company. The problem with that narrative, it's hyper-specific in a very specific time frame in history and is not the rule. Right now, in this interest rate environment, arbitrage doesn't exist at any carrier because interest rates are so much higher than the internal rate of return of that policy, even at some of the major mutuals. So I want to clarify that because it's something we actually talk about with our clients a lot if they've been educated by YouTube University before talking to us.
Yeah, what I would say here is I might take a different spin than you did on just direct versus non-direct is at the end of the day, and I'm speaking generally, so there might be companies that prove me wrong with how they do their thing, but direct recognition is they directly recognize a loan. And so in a lot of cases, you could find that their loan rates are going to be lower because they can, move the lever on the other side. Whereas the flip side, non-direct recognition, if you understand that companies aren't just going to lose, they're not going to be like, oh, you got me, now I'm stuck and like going to give you a quote unquote better long-term deal. Their loans can be higher. You're not going to find in a lot of cases a fixed non-direct recognition loan and have that compound over time. Now, again, there could be, out of all the carriers out there might be one or two that prove me wrong. But overall, long term, if you're working with a solid mutual carrier, you want it to be attractive to access your capital, but you ultimately don't want a company to actually be in a losing situation. You might think it's cool if there's actually a company that gives you a better deal, but you have to realize that that better deal potentially could put that company in a risky situation. So what I look at is, okay, early on, if taking a lot of loans are something that matters to you, like especially early on, instead of just looking at the direct versus non-direct, you should actually look at who gives me earlier cash value versus less cash value early on. So if all you care about is like, I want to use my capital early, I'm going to look at the company that gives me a lot of early cash value. And it might be a perk that it's non-direct because that's one less thing that I quote unquote have to worry about. But if you're looking at this as a long-term deal, overall, it's going to work itself out. And that's what many people in the space that I look up to, because I was really fixated on this, because when I first got in, I was working primarily with a company that was non-direct recognition, and that was part of the sales pitch. Like, if they're direct recognition, don't work with them, do non-direct. And the more I realized I had to course on that and just say, you know what, that's a metric that I'm talking about that doesn't really move the needle as much as I think it does. And so, Alden, I don't know your take on that. Overall, I think we've actually spent too much time talking about it as it relates to the importance, but I do think it's talked about a lot. So I think it's important for people to see the pros and cons. But the reality is there's companies on both sides that are very, very good. And if it's like a sticking point, knock yourself out. There's companies that you can do non-direct versus direct. I happen to own both. And trust me, the non-direct versus direct were not something that I was like a deal breaker. The last thing that I'll mention that is there's third-party lenders that can essentially wipe this conversation off the map. And a third-party lender essentially says, I don't care direct versus non-direct. You're going to put up your cash value and death benefit as collateral, and you're going to work with a third party that, shocker, actually gives you faster access to money, a lot more convenient, and in some cases more competitive interest rate. And a lot of our sophisticated clients opt to do that because it also potentially makes the loan deductibility that much cleaner if you're going to use your policy for business purposes. And so, Alden, we can move on unless you want to add anything more.
All right, so if you're following along in your guidebook, you know that I've got another 65 pages to go before I get to the end. I'm going to skip some stuff. So in the guidebook, we've got each one of the 10 carriers broken down into about 5 slides that talk about their specifics. So I definitely encourage you to check that out because it does have some really good details. I'm not going to go over it because we did the whole series for that purpose. So what I'm going to touch on now before we just start diving into some real dollar figures on these policy illustrations is just product complexity. One of the things that I found just comical and interesting is that the larger the insurance company, the more complex their insurance products are. The smaller, they're pretty easy. So I thought that was just kind of comical in general. But MassMutual, fairly complex because of their PUA rider, how it works. So they take the most complicated 8 out of 10 mark at the top. Pan American, I was shocked. This is a company I've never even considered before. I didn't even look at. Caleb has some history with them because they used to be Mutual Trust Life. But Pan American, their product is so simple. There's like, I wanted to give it a 1, but I feel like maybe I should hold out that 1 rating for some other unicorn out there. And so everybody else, they fall in between. Smaller companies, the bottom 5, larger-ish companies on the top 4, you can see complexity just varies. And so it's very important to work with an agent who, 1, understands the complexity of the product that they're trying to sell, but 2, that you understand what you're getting involved in from a flexibility standpoint. A lot of these ratings come directly out of that slide on the PUA flexibility side of things.
Yep. And Alden, I think that this is an important slide to talk about because with the more complexity, there's a lot more variables. We're assuming best intent, best design when we're going through the series. And unfortunately, the longer we've been around, the more we've seen like crazy stuff. I'll just put it that way, from companies that are great, but you're just like, how is this possible? And maybe to give their agent or advisor the benefit of the doubt, they literally, because it's super complex, they're doing their best. It could be a lack of training, it could be a lack of disclosure, it could be, who knows, maybe trying to give them the benefit of the doubt. And so there is something powerful about, simplicity for you, the consumer, but then also the advisor. And the more complex, you can say, the more variables, the more things that you can do, but also the more areas that you can get wrong and or might not be optimized. And so that's something, for better or worse, we've taken the approach because we represent so many companies. We have a high standard for getting it right. And so with this, we've just gone through the work, but it's very rare for people that will say that they work with multiple carriers to be at a high level because of the complexity route. And so just something that is important. If you're an advisor, it's important to learn. And if you're a consumer, it's important. And this is not a sales pitch to work with us, but it is important that whoever you're working with has an understanding of whatever companies that they're representing, the nuances there.
Absolutely. We've rescued many a policy that PUA can't be paid anymore and the client had no idea, right? So there's definitely reasons to go in with both eyes open. That's well said, Caleb.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video.
All right, now jumping into the numbers that I know a lot of you maybe just skipped all the way to. This is where we get a little bit more in detail. So a lot of numbers on your screen. We're going to do our best to break down what you're actually seeing, and then I've got a more simplified version that Caleb will go over as well. But high level, this is going to be our cash flow design. $50,000 a year for 20 years and across 10 insurance carriers. Now a caveat, 2 big caveats I'll throw in here. Every product at every carrier has an optimal way it can be built to be most efficient. I had to pick one way to build it across 10 carriers. So some critics may say hey, I can make Ameritas look so much better. You do that because of the funding time frame that we're looking at specifically, right? The second thing is because of the amount of data here, and not all carriers provide an Excel spreadsheet. Most of them just provide the PDF. I had to use AI to strip cash value and death benefit numbers out of each one of the 10 PDFs and load them in here. we've gone through it, and we actually, it's the second time filming this because we found some discrepancies. So give us grace in that regard, but we've gone back through this and we feel fairly confident that these numbers are accurate representations of the illustrations that I ran.
Then I'm laughing because out of all the time we were talking about companies, PUA flexibility, non-direct recognition, loan, all these things, let's be honest, most people skipped right here to the video. They just want to see the numbers. I could talk till I'm blue in the face about multi-benefits, yada, 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 but it's my, I wouldn't say track record, it's my understanding and just around that. I just know that the numbers tend to be the thing that people care about. And to be honest, it is something that we can start comparing. And while you just gave a really good disclaimer about we trying to create an apples to apples comparison creates sometimes a non-apples to apples comparison because some companies will design things differently. And so I think you did a great job with that disclaimer. Why don't you share what's happening with all these highlighting? Because I think that's also important for it's to help us, but it's also to help the viewer who's a little freaked out right now, how we're going to go through, because we're not going to go through every single number line by line.
All right. Awesome. So the numbers that we're looking at come from illustrations on these 10 carriers, and we're illustrating a 40-year-old male at a one level above standard non-tobacco health rating. So that's select at some carriers, it's preferred at others, but try to make it equal across the board. The funding time frame is 20 years, $50,000 a year, and then starting year 21, we have a premium offset where the policy is paying for all the internal charges itself moving forward. The key that we're using here is green highlighted in any one cell is indicating that is the highest cash value as compared to all of the other options in that year. Second color we're looking at is yellow. That yellow is second place, orange is third place, and then I've highlighted red as the dead last one as well. So high level, as we're looking at this, we can see that some carriers are out of the gate very strong. So all the way over on the right, Foresters, which was a bit surprising to me at first, very strong out of the gate the first 3 years, the highest cash value any of the policies that I ran. But then they start to slow down. Similar story in reverse for Penn Mutual. A little bit lower out of the gate, and then they speed up. So every carrier is a little bit different in the nuance here. But perhaps it would be helpful, Caleb, is to first jump down into this chart so people can get a good idea, and then we can go line by line.
Yeah, so let's punch into the chart here. And the chart breakdown is we look at the insurance carriers on the left, and then we have break even, capitalization, and efficiency ratio. So break even, what that means is when your cash value is greater than the cumulative amount of money that you've put in. It's something that I like to look at because it just looks at when you have more money than what you put in. And then the capitalization phase, that is something that a lot of people in the infinite banking space like to talk about. That's where your annual basis, your contribution that you put in, the cash value increases by more than that. So you can see that on one policy, Ameritas, it's year 5, and on Guardian, actually the second year in the example that we're showing, you're putting a contribution in and your cash value is increasing by more. And then the efficiency ratio, well, then why don't you break down the efficiency ratio?
Absolutely. So this is a new ratio I just kind of made up. I like IRR, but at the same time, IRR changes depending upon the year that you're looking at. This, I feel like, was a little bit easier way to explain the best in class at the end of a 40-year period. So what this is if we're looking at the total amount of premium we put in, how many multiples of that premium do we have in cash value by that 40-year mark? And understanding these are projections over 40 years. Nothing's going to look like this in reality. Dividends go up and down. But with that disclaimer out of the way, if we have an efficiency ratio, let's just say Ameritas, efficiency ratio of 3.4, that just means you put in $1 million, now you have 3.4 million after 40 years in that policy design.
Yep, well said. Okay, so when we look at just like break even, I tend to like break even for data purposes and IRR or the efficiency ratio. I think that for me highlights some really powerful things because one's representing long-term performance, one's representing the initial cash value like early on. And so if we look at, Ameritas, they happen to be A, but they also happen to have 2 red categories, especially on the break even and capitalization. So the policy that we ran, it breaks even in year 10, meaning for the first 9 years, you have less money than what you put in. And then Lafayette Life is the leader in this category, meaning in year 4, Lafayette Life has more money than what you've put in. And that can be very attractive, especially for people that want early access to capital. Again, just to be clear, break even doesn't, like, you can still borrow against your policy before break even. Break even matters when you're comparing, but shouldn't necessarily matter that much long term, because you should be long-term thinking when you have these policies. But when it comes to comparing, it does matter. And it looks like the average that we see is around 5 years. So 5, 4 years, even 6 years, all really solid. Now, on the capitalization standpoint, we have Guardian, like I mentioned before, is the leader here. Averages look like year 3 when it comes to capitalization, with Ameritas being year 5. And then the efficiency ratio, it looks like Penn Mutual is the heavy winner here with a 4.75x ratio, where it looks like OneAmerica is just under 3, 2.99. And it looks like average is maybe high 3s as it relates to that. Will just be important as we look at those things. All right, Alden, let's look at year 1. We see that Ameritas has a little more than $33,000 of initial cash value. And then when we look at the quote-unquote winner in this scenario, we have Foresters coming in at a hot $46,716. And so there's a pretty big initial difference there. But overall, I think it's important. I said this early on. Remember, we're looking at the top 1 to 2% scenarios, not just with companies that can do these type of policies, but also the way that we're designing. So we might not have gotten this super optimal depending on what carrier we're looking at on how they like to design. But overall, many people looking at this would wish they would have any one of these designs in the policy design that they have, depending on what carrier that they have. So I think that's important from a perspective to share. It looks like Lafayette is very attractive at $45,000. We also have Pan America that's slightly ahead of Lafayette Life at $45,600. And then everything else is in between here. We already went through the break-even winner, but let's look at year 10, and let's just see, like, year 10, we have Penn Mutual, was a little bit in the orange, yellow, and then in year 10 has 600,000, almost 601,000 in their projection. And we have OneAmerica, who's coming in at $541,000. So, you could look at this a couple different ways. The next slide, we're going to look at death benefits, and I think it's important to compare those because it matters, just like all the other benefits. Even though we're looking at one, I just have to remind you that this is one of many, many reasons why you should pick a company. But we got $60,000 difference. Doesn't feel like a lot, but it is a difference. Now let's go to year 20, and we look at year 20. We look at OneAmerica is at $1,400,000, a little bit higher than that. And then you have Penn Mutual at $1,676,000 as it relates to projections. So now we're looking at $270,000 difference. That's when we're starting to see there is a difference. And again, like, how much of these are going to change over 20 years, that's something to debate. You're looking at Pan America, very, very impressive, almost 6 million, very impressive. And you look at MassMutual, which is also very competitive long term. And so I don't know about you, just so far when looking at this, just if we're looking at the cash flow numbers, Pan America was like that company that I was not on my radar. I would have lost a bet if you were to say, before we looked at these, is Pan America going to be competitive as it relates to this? They're very competitive, and I think it's important to know. Anything you want to mention before we go to year 30?
Yeah, well, it's helpful that you're painting the picture the way that you are. Each one of these carriers, they're different, they're unique, they got product nuances, right? And to a point that you made earlier, with Ameritas, for example, their product is just not designed for this funding style for this period of time. If we do it a lot shorter, all of a sudden they're a lot more competitive. And so we had to kind of pick and choose our battles here. But the other one I'll just mention, actually two things. Penn American, I was absolutely blown away by. I'd never considered a company, after talking with their team, understanding their product. It's super simple, and it's actually fairly competitive. Mind blown. That was kind of cool. The second thing that I'll mention here is some of these companies, their claim to fame, if you will, is that they're very conservative in the way that they illustrate. So OneAmerica, Ameritas, and some others, they've said very conservative in the way they illustrate. Something that I would love to see from some advisors who've been working with them for a very long time, if you're able to share the issued policy with the projections versus your in-force illustration. If we can see that, because I have yet to see this comparative conservative illustration versus reality. I have not seen them perform higher than they've been illustrating for a while. And the same could be said on the far side of some of the more aggressive ones, right? If we're looking at Pan American, for example, This is fairly aggressive. They're in 1, 2, and 3 from a cash value perspective over the course of this policy. What's the track record? One thing I have appreciated about some of the larger mutual companies that we work with, including Penn Mutual and MassMutual, is they've got so much data that they can backcast. Now, they're probably also cherry picking, but they can backcast and say, look, we issued this policy 20 years ago, and it's within 1 to 2% of where we projected it would be by this day.
Yes.
That's impressive. I've just not seen that from some of the other carriers on the list.
Yeah, another way to say that is maybe not all statements are created equal, and maybe some people have more credibility than others, and people can take that for what it's worth. Okay, let's look at year 30, and we see that on OneAmerica's got 2,092,000, and Penn Mutual is in the green at 2,843,000. So that's a pretty big difference. Well, the runner-up, MassMutual, is 2.6 million and some change, so a little less. Penn Mutual's ahead by the second one by a little less than 200,000, but there's pros and cons, and you'll notice that not one carrier is green across the board, and I think that is just an important to note. And there's a lot of things that we could say as it relates to what people value early, long term, but anything you want to say before we get into the death benefit here?
No, I think it's great.
Okay, let's dive into the death benefit. And I think we can speed this up a little bit more because you already know kind of what we're looking at. And so in year one, you're seeing death benefits from $77,000 of death benefit to Guardian at $3 million. And again, just how we're designing things. We'll give that disclaimer till we're blue in the face. Obviously, there are certain term riders that need to happen with Guardian for us to get that type of funding. If you want to recall, you can go back to our video on Guardian, and Alden, you did a pretty good job explaining the example that you had to try to fit in the series by using the way that you designed. So you also look at, OneAmerica. If you remember, OneAmerica was not as competitive when it comes to their cash value, but check this out. They're pretty high when it comes to the initial death benefit as number 2 at almost $2.4 million of death benefit. And New York Life, which had 0 highlights, they were left out, as well as Guardian on the cash value side. When it comes to highlights, they got an initial death benefit that's high. One of the things that's really interesting about New York Life, though, is it seems like they got some red, which later on. Anything you want to mention before we get to year 10 here, Alden?
Now let's just plug in some numbers.
Okay, so it's year 10 where Guardian's still $3 million flat. Lafayette is still on the low end at $1.7 million of death benefit. And so that's a pretty significant, and you got everything in between. It's interesting. Security Mutual is like, hey, we're feeling left out. We want to get some highlight time. And so they have a initial death benefit at year 10, which is almost $3 million, which is pretty impressive. Let's go to year 20. Year 20, we have MassMutual. I feel like I'm doing a horse race. Like MassMutual snuck ahead. Yeah, so they're at 4.3 million. Another thing to just point out, while Guardian was initially high, their death benefit stayed the same and is almost, I won't say in last place, but pretty much in last place. But New York Life bailed them out at the low death benefit at 2.8 million. I'm sure New York Life and Guardian, they get along so well, so I'm sure they appreciated that. And then Forster's, their initial death benefit was somewhat low, but is at almost $3 million. And then let's go to year 30. I'm having way too much fun talking right now. Year 30, we have the green, actually Pan America, which again, will their track record actually play out? Not sure, but very impressive from a cash value and death benefit, $4.6 million of death benefit. And you have Lafayette Life at $3.2 million. I think it also is important, when it comes to death benefit's very important. We do a lot of term insurance, not like blends, but like actual independent term policies as well when we do planning. Don't think we need to get too much into that, but Alden, anything you want to mention before we go into the front load design?
Yeah, so just to capitalize on what you just said, the death benefit is important. Oftentimes when we're looking at cash value focus, that's driving the conversation. So the comparison between Guardian and Lafayette Life is actually one we do fairly often because they're two of the carriers we'd like to use for front loads, as we'll see in one of the next slides. The death benefit differences are massive. And so how do we make sure we're coaching that client correctly? Well, we're talking about human life value. We're talking about trying to make sure their family is protected and that they get the protection they feel like they need for their family. So if they decide to go with Lafayette Life, the likelihood is we're also going to recommend some term insurance to supplement the vast difference in that death benefit protection.
All right, now we're going to get to the front load, cash value designs, and death benefit. And one thing I just want to note, and we're very grateful for AI, Alden, right? That makes our life easy. And it threw us a little curveball by saying, you know what, you were doing the A to Z, but we're going to mix this up on you. And so we're sorry, but that's just the reality of what we're going with. We just got to roll with the punches that we've been given. But we did validate a lot of these numbers. And obviously, if you're watching this, that means the numbers are correct. If you're not, you're not. So that was probably the dumbest line I've had to say in this whole video. So, all right, anyways, let's go down to the chart first, just because I think it's important. So we have, again, we know break evens, capitalization, efficiency ratio. You guys know what that means. Let's look at break even, and you look at the winners, and we have Lafayette Life, Pan America, MassMutual. We got Foresters. That means with front loads, we're dealing with a lot of early cash value, which is fun and exciting, but that doesn't necessarily mean that they're going to break even that much faster, though you'll see a pattern that a lot of these break evens are much, much faster than the cash flow design. Looking at Ameritas, you could see that their break even on the cash flow design was year 10, and now it's in year 6. And you'll almost look at that pattern across the board. And so you're looking at many companies that are year 4s, and I would say the average is actually 4 or 5, which is cool. When you look at capitalization, MassMutual, Lafayette, they're shining, and it looks like the average, the number that most companies are at is year 3, meaning you can put an annual contribution and your cash value increases more by more. And then the efficiency ratio, there's, while Penn is still ahead, even though they're not attractive when it comes to front loads, break evens, or even capitalization, still long term, they are going to be the winner at a 5.74x efficiency. And you look at the red is going to be OneAmerica at 3.34x efficiency ratio. But you got MassMutual and New York Life that are very competitive. And I would put Mass and Penn very neck and neck. And I think if front loads are important, you're going to end up going with Mass over Penn if that's the only thing that you care about. And obviously, there's other videos that we can talk about different strategies there. But just want to highlight that. Anything you want to say before we get into the numbers, Alden?
No, let's go. Let's just dive into the numbers up here.
So we look at, front load cash value standpoint. We got Foresters in the green at over 94% first year cash value, which is just phenomenal. And you got Penn Mutual in the red. Ladies and gentlemen, Penn Mutual's got some red, and it is $82,000 of cash value. Again, don't know that Penn Mutual, we don't really use Penn Mutual a lot when it comes to this front load. That's a good example of a company like we're trying to play the rules, and not all carriers are going to thrive when it comes to front load. We got MassMutual at 92%, almost 93%, which is very attractive. And then you got Lafayette Life in number 2. I think you're going to start seeing why Lafayette is one of the go-to carriers when it comes to front loads, because they are number 2 first year, and then they are in the green after that till past year 10, which is really cool. Let's look at year 10. You got Lafayette Life with cash value at $669,000. So let's just say $670,000 on one end, and then you have OneAmerica that, even though the smallest at 613, I mean, it's pretty close. Probably very similar ratios when we looked at the cash flow design at 613. You look at Penn Mutual, who's number 2 right now. It's interesting. They were like red in year 1, but already at year 10, they're number 2 at 659. And then you look at MassMutual, who's 3rd on the list at 654,000. Let's look at year 20. Year 20 on the front load, you got Penn Mutual in ahead at 1,130,000. You got MassMutual right behind them at 1,085,000. You got Lafayette Life, that's still very competitive, 1,066,000. And you got OneAmerica that has not broke the 1 million mark. They are at 905,000. And again, we explained this in the series that we did, but we only have funded through year 10 in this example when we did front loads. Okay, year 30, we have Penn Mutual, 1.9 million. We have MassMutual, 1.8 million. We got Lafayette Life at 1.7. And again, if you're listening and not following along, they're not exactly 1.9, 1.8. I could say MassMutual's 1,853,000. And then you got OneAmerica at 1.3. And so OneAmerica, it's a pretty big difference, Alden. $600,000 difference. I mean, that's definitely something that would come up in a conversation if we were breaking things down. I also, just some observations as I'm looking, like Forrester's coming out strong, hot. They're definitely not the weakest, but even at year 30, there's almost a $500,000 difference in year 30. So I think that's a real scenario, is like, how important is first year cash value? And again, while Guardian is not highlighted at all, they're pretty solid. MassMutual, super solid when it comes to front loads. And then Lafayette Life, they're really, really solid. And when you look at the flexibility, when you look at the competitive cash value, and so this is why this creates lots of moving pieces. Anything that you want to say, because I'm having way too much fun looking at these numbers, anything you want to say before we get to the death benefit?
Yeah, what I'll say is that, when we start looking at these comparisons and then think about how we're going to use the policy, so definitely if we're trying to borrow the very first year, you're probably going to go with one of the top three, right, from a cash value perspective, if you're only looking at the numbers. Long-term growth, though, we obviously see some other carriers like Mass, like Penn, maintain a higher long-term performance. And Lafayette Life really comes in as the best of both worlds. So a lot of times with clients, we're looking at one of two carriers for front loads. Usually it comes down to Guardian and Lafayette Life for some of the other reasons we mentioned in our video on flexibility and the loan rate, and if it's guaranteed or not guaranteed loan rate. So nuances on nuances on nuances. And the thing that I think to remember with Penn, right, is even though they're direct recognition, if you want to front load and use a policy, even though you have direct recognition, the long-term performance of the contract, the way it's built, is just more efficient than a lot of the competition. So direct recognition in that case, a lot of times doesn't matter as much.
Well said. Well said. Okay, let's go to the death benefit. As we look at this, the initial surprise I have right off the gate is Security Mutual, out of all companies, is the lone leader when it comes to death benefit at $2.8 million when it comes to that. And then you got Forrester's that also has a very strong initial death benefit at $2.5 million. And you got Ameritas, which is at their number 3, $2.3 million of death benefit. And then you got Lafayette Life that's like, you know what? We're coming in at 1.4, almost 1.5. And so there's the difference. So between almost 1.5 to 2.8, there's the difference. And then you got a lot of lower twos with the other carriers that are not being mentioned. Let's go to year 10. You can see that Security Mutual is coming off strong at $4.1 million of death benefit. Again, just to let you all know, like, this is part of it was design. So take everything that we say with a grain of salt. You got Penn Mutual at the lowest at $2 million. That's more than a $2 million difference, which is interesting. Now, I'm just going to throw a scenario here. Let's just go to year 11, Alden. The reason I'm doing this is I think with front loads, there are term riders that really show that I think a lot of these are dropping off in year 10. So I'm throwing a curveball at you, and we're going to go year 11 just to try to look at this. Okay, so year 11, we actually have Pan America at $3.3 million of death benefit. You saw that Security Mutual was at almost 4.2. They dropped all the way down to 2.1. Why? Well, I could tell you why. There's some type of term rider that had to go in to the first 10 years for it to not to mech. And so that's the big $2 million difference there. You got Lafayette Life. Wow. They did not start strong, but at year 11, they're at $2.5 million of death benefit, which is very attractive. OneAmerica is also a top contender. And you got Ameritas at year 10. They were actually number 2 at 3.4, but they had some type of term rider as well that must have been dropped off, leaving them at $1.7 million of death benefit. Anything you want to mention, Alden?
Yeah, what I'll say on the design side, so a lot of these carriers we do business with, some of the carriers we either have not done business with or we do very little with. So we've requested some illustrations. And for example, Pan American specifically, the reason that they're so strong is even though we were only funding this for 10 years, they sent me a design with a 30-year term rider. So inflating the death benefit farther and beyond what's technically needed from the design perspective. And so when we're doing these types of comparisons across carriers, getting into the optimal design, we have to rely on the carriers at some point. And so this one I think could have been optimized a little bit more, but this is what they sent.
Yeah, and if we just go back, Pan America was pretty attractive when it comes to their cash value. So that's impressive because sometimes if you have the higher death benefit, you take a hit on cash value, and that's actually a pretty cool talking point. Okay, let's go to year 20, and we see year 20 Pan America with that disclaimer still at $3.6 million. And then you have Lafayette Life at $2.8 million in number 2. You got Penn Mutual at number 3 at $2.4 million. And you got Ameritas at a little over $2 million. All right, let's go to year 31. The reason we're doing year 31 is that 30-year disclaimer that you mentioned earlier. So the winner in year 31 is actually Penn Mutual, $3,142,000 worth of death benefit. You have MassMutual right behind them at $2.9 million. You have Security Mutual at $2.7 million, which is also like very, very attractive. And you have OneAmerica at $2.3 million worth of death benefit. So if you look out over 31 years, the high end, you got low threes, and low end, you have middle twos kind of deal. And so you got that. And I mean, it's interesting if you continue to look out. And again, all these illustrations, you take them with a grain of salt, but it seems like Penn continues to get strong. And I just also want to just point out, while Pan America is not dead last, the term rider does drop off. It goes from 4.1 million to 2.6 million. And so that's where, again, term riders, take them all with a grain of salt. It's really important. Maybe we'll do a whole series on the art and science of a term rider, but I think it's interesting, and almost every front load design had to have some type of term blend as it relates to this. Although I know we went through lots of numbers, we're still debating if we're going to share a viewable view of this, but maybe if there is, you'll see a link down below. If there's not, you can harass us in the comments and see if we can get that over to you. Alden, I know there's a lot. I just want to point out, if you're not subscribed to our channel and you appreciate the work that we're doing, it's a really great way to support what we're doing by hitting subscribe, hitting that notification bell, because we put a lot of work in this, and there will be critiques. I love critiques, and my point to you is like, do your own series as well, because, and I say that nicely as well, like there's a lot of work. We're continuing to get better. We are listening to feedback, but there's a lot of effort that goes into this. We're excited that people are going to be able to use this to make their businesses better. Hopefully consumers can use this to be better educated, but we appreciate your support, and we would love to help you. If you have policies that you want us to look at, if you want policies that you want designed, if you want to talk to us, we would be honored to work with you, and there'll be links down below for that as well. But Alden, there's a lot that we talked about. We ended on the numbers, although some people probably skipped to this, but we started by talking about company ratings, flexibilities, direct recognition versus non-direct recognition, whether you live in New York, whether you don't live in New York. And there's so many other things that we didn't even mention in the summary, because we've been at this for a very long time. I'm sure the editing team is going to cut this down, but we didn't record for 5 hours, but we recorded a lot longer than initially thinking. So anything that you want to say before we wrap this thing up?
Absolutely, Caleb. Well, this has been a fun series. I'm glad that we're wrapping things up now. And to kind of land the plane here, I want to just do a comeback recap of the best carrier for different scenarios, because everyone's situation is different. As we've seen with the numbers backing it up, Penn Mutual, that's a long-term performance type of carrier with some of the other flexibilities that they have. Early cash value, usually that was falling with one of these 4 carriers in most circumstances: Guardian, Pan American, Lafayette Life, and Foresters. High financial strength, if you really want that top tier carrier, Guardian, New York Life, and I'd also throw MassMutual's name in the mix because we're one of the big 4. But if we're talking about flexibility, Penn Mutual and even Foresters Financial, right? They're very flexible on the PUA rider. If that's a value you seek, possibly consider one of those carriers. Most IBC supportive, Pan American and Security, and then the overall balance, that's going to be Penn Mutual and Lafayette Life. All right, and to land the plane for this entire series, I want to give you a framework for how to make decisions on whole life insurance and finding the best policy for you. The first thing I would encourage you to do is define your goal. What are you trying to get out of this insurance policy? Is it performance? Is it early access? Is it another part of your portfolio that you want rock solid? Like maybe MassMutual would be a great option for that, right? Define your goals. Second, apply your geographic filter. Basically, if you live in New York, just shrink your options. That's what I'm saying. And then consider your funding strategy. Do you want something that's variable, maybe flexible in the funding opportunities? Are you doing a short number of payments? Maybe there's some carriers that might be better than others for only funding for a couple of years. And then also evaluate your risk tolerance. We didn't go into a whole lot in this video, but some of the smaller carriers have what I would consider niche risk. For example, policy loans out that it's taking up a huge proportion of their balance sheet as compared to the other mutual insurance carriers. Is that a risk? Is that a not? That's something that you have to identify. Last couple things I'll say is working with an experienced agent. Because we have so much nuance in the insurance space, oftentimes these are oversimplified products in a lot of realms, except for Pan American because they're super simple. But I think it's really important that you understand the product, and that means working with an experienced agent who can explain the nuance and guide you to the correct option. And that kind of leads me into what I call the Better Wealth Advantage. Our team, we're experts at this in the design space, in knowing which carriers to work with. We know this field and the subtle nuances of all these insurance products very, very well. So our team acts as your advocate. We figure out what's going to be the best option for you based on the many options we have available to us as an insurance agent in your corner. So Caleb, that's all I had to say. Let's go ahead and wrap this up.
If I had a hat, I would say hats off to you, Alden. Thank you for you, the viewer, the listener, for making what we do possible. We very much look forward to getting better, hearing your feedback, and we'd love to hear what you would like the next series to be, because we, again, are committed to being the best we can possibly be when it comes to getting the great information, leading with transparency, and being authentic as it relates. So we'll see how many jokes get included in the final edit. But with that, Alden, I appreciate you and very much look forward to seeing what people say in the comments.
Absolutely. Thanks, guys.